based on that gold revaluation, and then the inflation came from there. But in 1980, it was by the market itself, when the market decided that the other stuff on the Fed's balance sheet was not trustworthy. So it bid up the value of the gold to back the rest of the assets on the Fed's balance sheet, which is mostly debt, to 100%. And that made the rest of the debt trustworthy. Now the question is, what percentage of gold backing the rest of the Fed's balance sheet would make the rest of the treasuries trustworthy to hold for people? And if we go to the 1980 numbers, it's something like $40,000 to $50,000. So people think of that number and they're like, oh, this guy's a crazy gold bug. But it happened before. And once it happens, I'm going to get rid of my gold. I'm going to buy stuff. I'm not going to buy dollars. I'm not going to sell it for dollars. I'm going to buy things. And I'm going to call it the end of this game. I'm going to move on with my life. And we'll see what I do after that. But I know where the bell is because we've had 1980. So that's what I'm waiting for.
In today's episode, financial analyst Rafi Farber warns that the Federal Reserve is about to make a choice that could destroy the American dollar within months. For the first time since 1980, the Fed is cutting interest rates while consumer prices are accelerating, a historically catastrophic combination that breaks 40 years of policy and signals either hyperinflation or complete banking system collapse. The gold market is flashing crisis warnings with future spreads hitting levels seen only twice before, right before the 2008 financial meltdown and during the 2020 economic collapse. Farber explains that if gold backed 100% of the Fed's balance sheet, like it did in 1980, the price would need to hit $40,000 to $50,000 per ounce. Jerome Powell now faces an impossible choice: cut rates and trigger hyperinflation that destroys the dollar, or keep rates high and watch the banking system collapse. According to Farber, you can save one but not the other. Even the new stablecoin legislation won't save the system. It just adds one more layer to the pyramid that will collapse anyway. The endgame appears clear. A complete monetary reset is inevitable. As consumer prices rise faster than any time from 1980 to just before COVID, the Fed is cutting into a higher inflation environment, which means they will destroy the currency. Now we'll show you more clips of the latest interview, but first, smash the subscribe button and turn on notifications so you do not miss out on our daily recaps.
I want to talk about this in the context of course, gold being money and the dollar only being a derivative of it. And that's always hard. I keep going back to that because that's the number one message, but it's hard to keep it in your head and to take it seriously. Like people treat it like, oh, it's just a religious statement, like, God is one, whatever, but you don't really know what that means. But you have to understand what it means that gold is the money. If the gold is the money, then every time the price of gold moves, it's revaluing the dollar. Gold doesn't actually get revalued. The dollar is being revalued. Now, the question is, are we talking about statutory revaluation or market-based revaluation? You just cited two examples, one being 1933, which was statutory, right? FDR just decided, maybe on some advisement, maybe on a whim. I remember I read when I was turning libertarian when I was younger, I was reading one of Glenn Beck's books, decided if he's the path I wanted to go on. Ultimately, no, it wasn't. He was an influence, but I never really went down his path. But he was talking about, I think in his book, Broke, how FDR just decided on a whim to make it 35. I don't know, he was just like flipping numbers in his head and he decided that was the one. Could be true, I don't know. And then you were talking about the revaluation in 1980, where the price of gold in the market that you could get a gold coin for to shop was what was being revalued, and that hit 872 or 850, wherever you want to count the top. And ultimately, these are really the same thing. Right, they're brought about in different ways, and that's but they are monetarily speaking what is happening in the monetary system. It's the same thing. It just the difference is who's acting upon it. Like if a 50 kilogram weight drops on your head, you're not going to really care that much if it was, like, say, a meteor from God. Or let's say somebody had sinister would drop something on your head from 100 feet above you, or drop the piano on you. Either way, you're dead. It doesn't make a difference. So I don't think we're going to have a statutory gold revaluation. And what happens during a statutory gold revaluation? Well, you look at the price inflation statistics, which we have from the 1930s. And in April 1933, I think the deflationary, and I'm talking about consumer prices, the deflationary statistics were something like -9% a year. And then by about 10 to 12 months after the revaluation from 21 to 35, price inflation shot up to positive 10, 15% or something like that, like a huge move. And really that was the point, because by revaluing, that gave FDR's government, or the Fed under him or beside him or whatever, the ability to print more money based on that gold revaluation, and then the inflation came from there. But in 1980, it was by the market itself, when the market decided that the other stuff on the Fed's balance sheet was not trustworthy. So it bid up the value of the gold to back the rest of the assets on the Fed's balance sheet, which is mostly debt, to 100%. And that made the rest of the debt trustworthy. Now the question is, what percentage of gold backing the rest of the Fed's balance sheet would make the rest of the treasuries trustworthy to hold for people? And if we go to the 1980 numbers, it's something like $40,000 to $50,000. So people think of that number and they're like, oh, this guy's a crazy gold bug. But it happened before. And once it happens, I'm going to get rid of my gold. I'm going to buy stuff. I'm not going to buy dollars. I'm not going to sell it for dollars. I'm going to buy things. And I'm going to call it the end of this game. I'm going to move on with my life. And we'll see what I do after that. But I know where the bell is, because we've had 1980. So that's what I'm waiting for. There are different kinds of dollars out in existence. Right? There's the monetary base, which is the stuff that's on the Fed's balance sheet. Right? When the Fed buys an asset, it creates new dollars and gives them to whoever gave them the asset. That's base dollars. And then you have commercial bank deposits, which are created through loans and other activities, which are built upon that base. So the number 40, 50,000 is based not on commercial bank money and not on the M2. The M2 is base money plus all the loans that are made piled on top of it. Just talking about the monetary base. The monetary base itself is the balance sheet, and all the assets on the balance sheet. And then you have a little bit of gold, 235 million ounces, the unaudited, whatever. Let's just assume it's there. So if we were to take the monetary base and take all the value of that in dollars, and then the tiny amount of gold it has on its balance sheet, 235 million ounces, if we are to equate the dollar value of those 235 million ounces to the rest of the pile on the balance sheet, which is the monetary base, it would have to be I think it's about 50,000, or it could be 55,000, somewhere around there, like between 40 and 50 or something like that. It doesn't really make a difference. But that's what we're talking about. I'm not talking about covering M2. I don't think we're going to get there, because to cover M2 is what, like 21 trillion, whereas the monetary base is like 5.6 trillion. It had to be 4 times that. I don't think we're going to see $200,000 gold. I think the dollar's going to break before that. So that's the calculation we're talking about.
It's interesting when you're mentioning FDR and how...
Right. There is no getting the government's fiscal situation under control without destroying the banking system. The government, it's hard to say how much they believe in what they're saying, these position papers, and how much is propaganda and how much they're just making it up. I don't know. But the way that they're thinking about it, they say, look, we have this gold. It's not really 42. If we just stop lying, then we have all this free money and we don't have to raise taxes and we don't have to increase the debt. It seems like free money, right? How could you go wrong? And if you don't understand that gold is money, and if you revalue the gold dollar ratio, you're not changing what money is, you're changing what the dollar is. And if you change what the dollar is, that affects all prices down the line very quickly, not overnight, but within months. When FDR did it, it was a 66% revaluation. It took about a year to get to maximum price, consumer price inflation. So if you don't, I don't think anyone in the government understands that gold is the money right now. And because they don't understand that, they see this as like a mathematical trick that can just, give them manna from heaven, free money. And they say, like, why don't we just do that? And then the only reason they don't, I think, is because maybe there's some traditionalist people, or maybe they don't fully buy into their voodoo. And they're like, maybe this is not such a good idea. It's like Louis C.K.'s famous comedy bit, of course, but maybe, of course, free money is great, but maybe destroying the dollar isn't such a good idea. They're not sure about it. So we'll see what they do. And if they don't do it, the market's going to do it anyway.
In today's news recap, on August 1st, the Federal Reserve published a research note called Official Reserve Revaluations, the International Experience. It outlines how 5 countries used gains on their official gold holdings to raise funds. It does not propose the U.S. do the same, but it explains the steps involved and what to expect if it happens. The note covers Germany, Italy, Lebanon, Curacao, and St. Martin, and South Africa. Some used revaluation proceeds to finance debt. Others used them to cover central bank losses. The examples, though limited, show how governments have tapped into hidden value without raising taxes or issuing new bonds. The U.S. Treasury values its gold at $42.22 an ounce, a price set in 1973. It holds 261.5 million ounces, the majority of it at Fort Knox in Kentucky. At the official price, the gold is worth $11 billion. At today's market price, it would be worth more than $750 billion. The article explains that revaluation would not require selling the gold. It would simply update its book value. The Treasury could adjust the value of U.S. gold reserves through a few bookkeeping measures. It might retire its current $11 billion gold certificate and establish a higher official price for gold, which could be lower or even higher than the market price. Next, it could transfer the gold to the Fed at this new price, potentially gaining billions or trillions. Remember, it need not revalue the gold to the current market price. The Fed would then return the gold to the Treasury for a new certificate. No gold physically moves, but the Treasury ends up with a significant amount of newly created funds. The cash infusion from the revalued gold could be used to pay down debt or finance new spending. Now we'll show you more clips of the latest interview, but first smash the subscribe button and turn on notifications so you do not miss out our daily recaps.
I'm guessing here as to a causal or a rational, let's say, Austrian view of what is going on, or a positivist view. You try to link it up to why humans would behave in such a way that this would precede a financial crisis. So I think what you're talking about is there was a chart that I saw on Gold Charts R Us of the gold maturities from spot all the way to the farthest out future, and I noticed that in 2007 up to the 2008 financial crisis, the spread really got pretty thick. Right. And also in 2019, from the repocalypse, from when the repo rates started to spike up and the Fed had to restart QE, until and especially through 2020 during the lockdowns, they really got pretty thick also. And they're doing it again. It's been that way since, I think, 2023, since the regional banking crisis. I might be a little bit off on the dates. I haven't seen the chart in a while, but why would this be? And I don't have a perfect answer, but if there are problems with the dollar, then what you would see is spot gold going pretty high relative to other maturities, but going out into the future I think you would compress in the middle, and then the price would go higher out into the future because you'd have speculators that are also worried about the dollar because they want to they're using gold to speculate because they see something wrong with the dollar, but also you have the people at the mouth of the pipe, the big banks, and they are going after spot gold itself. So you're having these like kind of zigzaggy, wavy maturity scheme, and I think that's what's happening now. But you'd have to look at a chart of this. It's available on Gold Charts R Us to see all the maturities and the different colors of the lines, and they get wider as we get closer to a crisis. So the chart goes back to, I think, 2005, 2006. The only time I've seen the maturities be this spread out are 2008, 2020, and now. So the question is it happening again? And there are other signs that corroborate it. How far out are we? I don't think we're very far. You know, people say like I've been around since 2020 saying the same stuff, but it's 2025. Even 5 years is not that much time. I know that's kind of a cop out, but it's also true. And gold is still money. I mean, it doesn't really matter because I know what the truth is. People can say what they want, but the reality is reality. It's not going to change.
What do you think of today's episode? Do you agree with Rafi Farber and his warning about the Fed's impossible choice? Will cutting rates destroy the dollar or save the banking system? Is gold the only protection against monetary collapse? Post in the comments section down below your honest opinion. Share this video with someone who needs to hear this warning. Subscribe and hit the notification bell to get future updates.